We are here today with our special guest, Marlon Nichols. Let's see, just gonna get our questions going. All right, everyone, welcome to another exciting AMA. I'm Jen Consalvo from Established, the company that powers the Start of the Year program and this summit. As I mentioned, I'm thrilled to be joined today by Marlon Nichols from MaC Venture Capital. Thank you, Marlon, for joining us today.
No, it's my pleasure. Thanks for having me.
Awesome. All right, so quick programming note for all of you in the audience. Here's how it's going to work. I'm going to kick things off with an overview of Marlon's background and ask some questions, but our hope is that you will take advantage of the session and ask the questions that you want to hear about. So just put them in the chat box and we will jump into the questions as soon as we are aware of them. Also, if you want to share the love during this session, if you're on social media, just use hashtag #StartupOfYear or Startup of the Year, and we'll jump into those conversations when we can. All right, so here's a little bit about Marlon. Marlon Nichols is a founding managing partner at MaC Venture Capital, formerly known as Cross Culture Ventures. He finds interesting entrepreneurs who are building the future of the rest of America. He's a former Kauffman Fellow and Investment Director at Intel Capital with an extensive background in technology, private equity, media, and entertainment. Marlon's unique eye for global trends and shifts in consumer behavior has helped him capture many high potential investments, which include Gimlet Media, MongoDB, Thrive Market, Fair, Listener, Maven, Blavity, Wonder School, and other companies that reflect overlooked markets. He serves on the board of directors for Ajuya, Blavity, Kauffman Fellows Program, Listener, Riff, and Wonder School. He has a ton of awards that I'm not going to list right now because we'll be here for hours. And he's an adjunct faculty in entrepreneurship and venture capital at the SC, that'd be South Carolina Johnson, or is that, what is SC? Johnson College of Business at Cornell University. All right. Marlon, welcome.
Well, thanks for having me. I'm really glad to be here.
So can you tell our audience where you're joining us from today?
Yeah, I'm at home in Southern California, Los Angeles specifically.
Nice place to be right now. So let's get started by hearing a little bit about your journey. First of all, where you're from, how you wound up in Southern California, and a bit along the way about how you got into VC.
Sure. So I was born out of the country, actually. I'm an immigrant. So I was born in Jamaica, West Indies. My family moved to the US when I was about 7, to New York. And so I grew up partially in New York and partially in Jamaica. I would spend basically every summer on the island with my grandmother. Until I was about 15 and got, real serious into sports. And then the summers were filled with camps and things like that. I studied MIS at Northeastern University, and that was kind of where I first got into tech and kind of the startup world. Right after graduating, I joined a seedstage enterprise software company called Frictionless Commerce. And within a year was asked to move to the UK to basically build and grow that company to serve the UK and Europe. So I spent 3 years doing that. Ultimately, that company was acquired by SAP, and I decided that I didn't want to be an operator, nor did I want to work at a really large company. So I left and went back to the US, moved to Harlem, New York, and got into strategy and technology consulting. And initially, I was working with the Blackstone Group in kind of post M&A integration work, and then that turned into pure play strategy consulting role focused on media and entertainment. So working with companies like Warner Music, McGraw-Hill, and the gig was basically to help them to understand how to embrace and make the best use of the internet, which was becoming ubiquitous. Then I went back to business school. I decided that, consulting was different than operating, but maybe too different. And I wanted something in the middle, which for me was venture capital. So I went back to business school at Cornell, and I had the privilege of leading the school's pre-seed venture fund for the 2 years that I was there as its CEO. After graduating, joined Intel Capital, which at the time was the largest and most active venture firm in the world. We deployed up to 500 million per year into Series A, Series B companies. Following that, I started my first fund, which is called Cross Culture. That's about a 5-year-old vehicle now, very, very well performing vehicle. And now we're on to our second fund. We did a slight rebrand, and it's called MaC Venture Capital. And we're a seed stage venture fund with presence in LA and the Bay Area.
So when you say seed stage, can you tell folks like typically what size checks you're writing at what point?
Yeah, so seed for us means that you have a viable product, you've built it, and you're starting to get some feedback from the marketplace. So you're probably not, in most cases, you're not all the way live with your launch, but maybe you're in beta, or maybe you have some beta customers if you're focused on the enterprise side, and there's some data that we can look at to start to to see trend lines and things like that. So that's kind of how we define seed, and there's a range within there, and different levers. You can pull different levers to get to a yes, but generally that's where we are. And our initial check size is up to 1.5 million, and we're targeting it's basically 10% ownership at our first investment.
All right, so our first question from the audience is, what would be your advice to a fintech business that is trying to secure a seed investment from VC? We're at the MVP stage.
You're at the MVP stage. So these questions are always hard to answer, right? Because I don't know enough about your business to truly be helpful. I could tell you for us, what we look for is who's using the product, and I don't even know what kind of fintech product it is,
right.
But like who's using it, how often are they using it? If you are generating revenue already, what does that look like? How's it growing month over month? Typically, we like to see at least a quarter's worth of data, maybe 2 quarters worth, and you want to see things going up and to the right in a consistent fashion. And that thing that's going up and to the right is the thing that's most important to the success of your business, or measuring the success of your business. So it could be revenue, it could be member acquisition, it could be dollars spent on the platform, it could be a number of things.
Right. And that's a really important point too, especially if you're at the MVP stage, right? It's understanding the metrics that really drive your business, because it's really easy to get caught up sometimes, right, with the wrong metrics if they're numbers that make you feel good.
Yeah, it's definitely what is important to the success of this business. How am I measuring that, and can I show a growing trend as it relates to that metric?
Okay, so someone just asked us, Marissa, what about considering seed stage enterprise SaaS companies pre-revenue?
Yeah, we don't necessarily need it to be generating revenue. If it's enterprise SaaS, what we're looking for there is who's buying into it, right? So what does your customer wait list look like? Do you have pilots pilot customers that are working with you? What are they saying about your product and likelihood of becoming a paid customer? There are a number of things. One of the more successful companies in our current portfolio is a company named Pipe, which is all enterprise SaaS, and we invested pre-launch. Actually, they had the product, they had a massive wait list and a value proposition that just resonates with SaaS-based companies. And so, we took that, spoke to some of their customers, and we had a pre-existing relationship with the founders, and made the bet to go forward. And that's panning out really well for us.
That's interesting. So when it comes to investing in a company that's pre-launch, is it usually because there's something about the founders, you have a pre-existing relationship, or they've got the experience and know-how, or is it just depends on the unique situation? Because that's something we often advise people, just get something out there and launch it. You're probably not going to get an investment before you have something to show for yourself.
Yeah, it's kind of all of the above, right? And so in this case, it was like all the stars and moon, the planets, everything aligned, right? I've worked with the founders before in another company, which they sold, and we maintained a relationship, so I knew them well. The problem that they were solving was a really big one that resonated in a significant way with with their target customer base. And then they had a massive wait list of folks that were just clamoring to use the product, right? And were willing to speak to us about why they found it so compelling. And then the product itself was really slick. It was built. It was pretty much pretty well baked by the time that we invested. They just needed to turn it on.
Right. So I very often see people send me decks of an idea, right? Like, this is what I want to do. I'm a first-time entrepreneur. It's, this concept's amazing. Should I start sending over to investors? What do you tell folks when you hear that?
So that's usually not a seed stage investor, right? Just going back to the definition that I shared earlier. If you have an idea, I would say build something, right? Get something going, and then raise a friends and family angel investor round, where their requirements are going to be less, right? To basically to give you some capital so that you can get started. But even then, I would be, if I were in that entrepreneur shoes, I'd be reluctant to start to ask for capital before I actually have started to put something together, because everyone has ideas, right? It's about how you execute.
hmm So another question that just came in, is it true that it's best to have a co-founder to raise capital?
Not necessarily. You should have by the time you get to our stage, you should have a team. But I don't know that having a co-founder is necessary, right? It's about who is building this thing. Why are they uniquely qualified to go after this opportunity? And are they able to convince other really talented people to come along on this journey? That's kind of what we're looking for in the team.
hmm Another question that's just come in. Does a term sheet come before the diligence?
Yeah, usually no. You're before you put down a term sheet, which what is a term sheet, right? It is basically um, the blueprint of what this deal might look like, right? And so before we can, first of all, we have to decide, like, do we want to do this deal? And you can't do that without doing some level of diligence. Now, after the term sheet, there's another type of diligence, legal diligence that has to occur. Maybe IP diligence, things like that. That are more technical and legal in nature. That would happen. But yeah, like understanding the market, understanding the competitive landscape, speaking to customers. You have to do all that stuff and make sure that you have real conviction for the opportunity before you put down a term sheet. Because while it's not binding, it's essentially a signal that, yeah, if legal diligence checks out, we're moving forward on these terms.
Right. And we had an AMA earlier with Mark Nagar from Greater Colorado Venture Fund. And I know they were having a conversation about, it's also important to be doing your homework too with the investor, right? Like this is a relationship. This is your investors are now sort of an extension of your team, and you need to, you need to like your investors. You need to believe in them, and it's not just a one-way street.
Yeah, absolutely. It's about really building a relationship, right? I'm looking at an entrepreneur and their team to figure out, one, do I believe in the market opportunity in front of them? Do I believe in the viability of their product long term? And do I believe that they are the team that can pull this off? And then, kind of fourth, and it's not in that order of importance, but is this a group that I will enjoy spending time with over the next 5 to 10 years? Can we work well together? Do I trust them?
Yep. All important things. Another question coming in. What should startups think about before contacting a VC? What kind of question impresses you?
No, I wouldn't say a question per se or any specific question per se would impress me. I like authenticity. So when we connect, just be transparent, right? What the things that inspire me are, either ideas that are kind of market creators, or or businesses that are solving for challenges that haven't been addressed, or haven't been addressed adequately over the years, right? Where you have a real opportunity to become a category leader. But yeah, no, I'm not looking for you to ask me, an amazing question, and that's going to like seal the deal. It's more about I want to understand your business, what it's about, and who you are, and and to make a determination as to whether this opportunity is exciting enough for me to want to spend a significant amount of time on it. And do I like you as a person and as a founder enough where I want to spend time with you?
Yeah. All right, boy, the questions are rolling in. Question from Ashley. If I have received seed money in exchange for a portion of my company, will that deter VCs from investing later? What is the max I should give for the initial fundraising, like friends and family round, so I don't deter future investors?
Hard one to answer. I mean, after the seed stage, you want to have, in terms of the founders, you want to have anywhere between, let's say, ideally 45 to 50% of your company that you'll still own, and that's after the seed. And usually at seed, you're parting ways with about 20% ownership of the company. So I'd look at it that way. Series A, you're going to part with another 30% of your company, and then I think from there on, assuming valuations go up, it's less and less. It starts to get less. But by the time you have a liquidity event, if as a founder you have or founding team, you have about 10% of the company at that point, and you've done your job. 10 to 15%, you've done.
So another question, I want to make sure I understand this question. How do you look for a new startup without traction? So maybe they mean, how do you look at a startup that might not have traction yet?
Yeah, so I mean, those are more difficult for us, right? We like to have some data that we can point to that confirms our opinion of the opportunity. But there are always exceptions, and so one idea is that if you're building for a challenge or a problem that we're very, very familiar with, and and see as something that is needed in the world, and can become a new category that's lasting. Something like that could be interesting. But you'd still have to have a product at that point, and we'd have to really, really believe in the opportunity and in this thing that you've started to build. But that's rare for us to have no traction. Like, no revenue is one thing, but no traction is a little bit different.
All right. So how do you research? This is basically advice for startups on how do you research and target a VC that has passion, skills, focus for either your target industry or type of software. So like medtech, SaaS. So basically, how do you do your research, your homework, and find the right VCs that would be interested in your business?
I mean, just like you'd search for anything else, right? To a Google search, you just put in my name, you'll see things that I've talked about, things that I've written, etc. I would visit their website and see the types of companies that they've invested in. Maybe they have we have categories that we slot our portfolio companies into. That's another way to do it. But yeah, I think, and then we publish reports, these state of technology and culture reports that capture a lot of our thinking in terms of what we're looking for today.
It's really interesting because I've done that not only for our past company, but in working with a lot of startups where we were helping them raise capital. And there is so much out there. And just an important point, I think, to reiterate for startups is do your homework. You know, VCs have websites. You can look at their portfolios. You can look at articles written about them. There's like a gazillion lists now of like, oh, the top VCs in X, Y, and Z, or seed stage investors. It's not just about what they're interested in, but the level, right? Because you're not going after an institutional, a VC that invests at the C stage if you're at a seed round. You know what I mean? So startups, it's really, really important to do that homework, find the right type of investors for your stage and the type of company that you have. So another question coming in from Marissa. Crunchbase Pro, let's see. Is that a question? Crunchbase Pro is great to see which investors invest in what and finding out who funded companies in your space. Yes, so that's a tip. Crunchbase Pro, you can look at all kinds of sites out there. Even I think if you look at AngelList and others, start to get sense.
There's a lot of them. The only challenge with that sometimes is like we're not always up to date. our record is not always up to date on those platforms, right? Because maybe we didn't send in like this quarter's deals or whatever. So they're good, and I definitely encourage founders to visit those. But I think you got to just kind of do general wider research as well.
I love this question. Have you ever wanted to invest in a company and your partners did not? Who decides to move forward with an investment?
Yeah, that's happened. We all have different perspectives and things that we like and don't like. Our process is a little bit different, where we have maybe a little bit more autonomy than some folks. We all participate in the diligence process in some way, and are kept up to speed in terms of what's happening with the company, what's the opportunity here, how big is it, all the questions you need to answer about a company, and then we get to the end of the process and we have a conversation, and at the end of the day, the lead investor on our team, we're going to give deference to their decision, having heard everyone's opinion, which is kind of a lot of pressure on that, and accountability on that person, right? Because if everyone is beating the table and saying we should not do this, and you do it anyway, well, you better be right. so that it forces us to be more diligent in our decision making process, but also affords us a level of autonomy that we all seek as as seasoned investors.
Right. And just a few minutes remaining, but I know we've got some more questions, so we're going to try to get them in. This is an important one. Does it matter if the startup is an LLC versus a C-Corp when seeking a seed or pre-seed round?
Yeah, we so venture cannot invest in limited liability organizations. It has to be a corporation.
Yeah, and I can chime in on that. There can be exceptions where you can get investment as an LLC. It's complicated. Most VCs will run, most investors will run from it. So if you're serious, if you see yourself as a company where you're going to raise money, you may seriously want to consider, if you're currently an LLC, changing it before you go down that path.
Yeah, I mean, there are things like setting up blocker organizations and stuff like that. But yes, it is complicated. And if you're going to take in, if you're planning to take on capital, you should just become a corporation.
Great. All right. Advice on how to make the good pitch to investors. What are the top 3 things that they're looking for while pitching? 5 minutes versus 10 minutes pitching?
So, so I mean, yeah, that's hard, right? So when I schedule meetings with founders, they're 30 minutes to 45 minutes, and basically we're having a conversation about the business. Yeah, you're gonna have your talking points, you're gonna have your deck, and you're gonna talk to your deck, but we're gonna ask questions throughout, and we're gonna make it super interactive. So there isn't, I can't say have your pitch down to 5 minutes or 10 minutes or whatever. It's going to depend on the scenario. The things that are important though, really you want to make sure that that investor understands that this is a venture scale business, right? So what is the market opportunity that you're looking at? How's what you're building novel or different from whatever else is in the market? Basically, how will you win and how will you protect your position, in this space? And then why are you uniquely qualified? Like, why are you and your team the team to back, in the building of this company? Those are the things that I'm typically focused on. And obviously, you have competitive landscape and stuff like that thrown in into those first 2 buckets essentially. But those are the 3 things that I really want to understand. And then, how do you scale this thing, right? What's your plan to go to market and build a really big business?
And another question, what does MaC Venture Capital provide companies besides capital? How are you connecting your networks with the founding teams?
Yeah. So this is where we differentiate a lot as a seed fund. So first of all, we believe very heavily that how you introduce yourself to the world, how you tell your story, has an outsized impact on how quickly you can scale and how large of an organization you ultimately become. And so, because of the marketing and kind of talent management backgrounds that we have within our partnership, we are uniquely qualified to help companies formulate that story and and get out the gates fast. That's one thing. Also, given our backgrounds, and you kind of heard my background earlier, but enterprise software, government. One of my partners was a former mayor of Washington, D.C. One of my partners was a Hollywood super agent. My former co-founder was an exceptional music manager and angel investor. So those, and an operator. And so those, career experiences or professional experiences have helped us to build relationships, like deep relationships, at the highest levels within media and entertainment, professional sports, Fortune 500, kind of the who's who in startups over the last 20 years. We've worked with them in some capacity, and government, right? And so, we have a number of examples where we've been able to introduce our portfolio companies to their first large customers. And then that large customer actually becomes an acquirer, ultimate acquirer of the company. So those are the ways that we help.
Yeah, that's such a competitive advantage in terms of getting the deals that you want, right? And creates this beautiful environment, this ecosystem for everyone. So awesome. It is time for us to wrap up. This flew by so quickly. Thank you so much for being here, Marlon. We appreciate your time and for contributing all this great information to the Start with Your community. For everyone else, thank you for being here. We're wrapping up now. Make sure to go over to your schedule, look for a session that you want to be part of. Dr. Hemina Hartsock is jumping on. She's from Phone to Action. Amazing story about an entrepreneur, an idea, and an amazing company. Thank you all. Check out all the sessions today, and we'll see you online in a bit. Thank you, Marlon.
Yes, bye.